everyone, my name is Sarah Darcy and I'm a partner in our private assurance practice. I'm joined today by Paul Shepherd, a partner in our corporate reporting team. Paul is an expert in financial reporting and we are here to talk today about things that private business CFOs should be thinking about as we head into the 2025 reporting season. Welcome, Paul.
Thanks for inviting me, Sarah.
So Paul, with 30 June fast approaching, what would you recommend our private business CFOs start thinking about and preparing for the 2025 reporting season?
Look, this is a great place to start. We've prepared a document that summarises a lot of the things that people should be thinking about this June. So maybe we can touch on a few of those items. Maybe things like tariffs, changes to some accounting standards, and what we're seeing with ASIC, the regulator.
So if we start with changes to accounting standard, the classification of borrowings as current or non-current can be contentious for some businesses at year end. Our AASB 101's been revised, and is there going to be a significant impact as a result of that change?
That's a good question. Will there be a lot of change in current, non-current? Probably not, but it's still an important topic for people to be aware of.
So do we really need to discuss these changes then?
Well, in my experience, not knowing and not being prepared is really what causes the problems for people.
Yeah.
So there are two main things to be aware of, right? The first is similar to what's always been the case. You really need to be prepared for 30th of June, right? So you need to understand how you'll be with covenants and you need to make sure that you've had any conversations that you need to with the bank before the 30th of June.
Yeah.
The other thing is probably new for people, and that's that there are some additional disclosure requirements, in particular where there might be some challenges in meeting covenants in the year ahead.
So could you possibly share a little bit about what we need to think about at this 30th of June and ahead of that timing?
So these amendments make it clear that when you're determining current and non-current, it's based on the covenants that were applicable and tested for the 30th of June, right? So the first thing is, does the test have to happen before the 30th of June? Even if you do the calculation after the 30th of June, right? And so where a breach is expected, it's important that you get any waivers from the bank before the 30th of June. So if you get a waiver, the waiver has to be permanent. Sometimes the bank will reserve their rights to still ask for payment. And if the bank does that, you need to make sure that they can't ask for that repayment within a period of 12 months from reporting date. And the other thing is, if you reach an agreement with the bank after the 30th of June, right, but when you do the calculations, you've got a breach at the 30th of June, then you're going to end up with a liability that's presented as current.
So if you sort your 30 June one out, but if you then are looking at the September's or future covenant breaches and they could be breached, what do you need to do? And could that cause it to be current at year end?
So when the test is performed after year end, like at a date after year end, that's not going to cause the liability to be presented as current. But now there is a requirement when you look forward and you could see that there could be a breach after year end. So for example, if you had done the test using the same criteria at June and you would have failed, then you need to give some more disclosure now. So you need to disclose the carrying amount of your liabilities. You need to disclose what the covenants are and how they're tested. And then you also need to give some information about the facts and circumstances that kind of made you think that there could be a breach in the coming year that could cause a repayment early.
So now is the right time for businesses to start thinking about the classification of their borrowings. Could there be potential breaches? And talk to your lenders now. Don't leave it too late.
Yeah, definitely.
Yeah. So something else that's new for 30th of June is that there's some additional requirements for disclosures around supplier financing arrangements. A number of CFOs on this call may be sensitive to providing some of that level of information. So why did the board go and make these adjustments and amendments so quickly?
Yeah, so that's a good question. There was a lot of focus on supplier financing around that time of COVID. And what was happening was the users of the financial information were asking for more detail on when companies were using supplier finance. The changes here are about additional disclosure rather than changes in measurement. And so what that meant was the board could make these changes a lot more quickly.
And so how do supplier finance arrangements impact cash flow and liquidity of a company?
So for supplier finance, there's normally sort of two main ways they impact a company. So the first is that the arrangement enables the purchaser of goods to make payments later. So what happens is the bank will pay, or the financier will pay on behalf of the customer, and then the customer will pay at a later point in time. The other arrangement is often that the supplier needs access to liquidity earlier on. And so what they arrange is for the financier to pay the supplier earlier, normally at a discounted amount, and then for the customer to pay on the normal payment terms.
Right. And so if I'm a preparer of simplified disclosure financial statements, do these disclosures apply to me as well?
Yeah, unfortunately, you can't avoid them. ASB 1060 requires these disclosures as well.
Yeah, perfect. And what do those disclosures require?
Yeah, so what are the disclosure requirements? A summary of the terms and conditions of the supplier financing arrangement.
Yeah.
It needs you to disclose the carrying amount of any liabilities that have been paid early by a financier.
Yep.
You need to provide a comparison of the payment terms for your normal sort of supplier arrangements and then those that are provided under supplier finance. So, for example, I pay 45 days normally, but I'm paying 90 days where I've got supplier financing. There's also a need to give some information where there's been a no cash flow to settle the financial liability. So an example of that is where the financier has paid the supplier, but you owe them later on. And so what you see is the liability will move from creditors to some sort of other supplier finance amount, but there hasn't been a cash flow yet. Yep. And the last thing that you need to make some disclosures about is when there is like a concentration of risk or liquidity risk because you're using the financier.
Yeah, so that's really helpful and quite a lot of information people are going to have to disclose. So another question that I know is top of mind for some of the private business CFOs is tariffs. And in what ways are tariff policies impacting private businesses, and what steps do you recommend that they take in preparing for the financial reporting and operations going forward?
So tariffs are an interesting topic, aren't they? Because I feel like at the moment, every day I wake up and there's something new happening in the space when it comes to tariffs. To me, it feels a safe assumption that for many of the people on this call, they're going to be impacted by tariffs in some way, right? Something in the supply chain is going to happen. It could be that they have to pay a tariff directly, that they purchase goods with an increased cost, or that their sales might be impacted by tariffs. And so the common areas that we've been discussing with our clients so far are around revenue recognition. So do your agreements with your customers allow for a change in price linked to tariff?
Yep.
And have you thought about how that might be reflected in your revenue recognition? Do you need to make a change?
Yep.
What's the impact there? Cost capitalization. So obviously, things where a tariff is charged are going to cost more money. My reflection would be that more often than not, you'll be able to show that there's a direct link to the cost of the asset, and you'll be able to, capitalize it if you've got something that can go to the balance sheet.
Yep.
But the last area is impairment testing, right? So if you think about it, lots of impacts on revenues, possibly impacts on costs. Those things all impact the impairment calculations that companies are preparing.
So could you share us a little bit more about asset values and impairments? What happens if things keep moving after the year end? What does that mean for us?
Yeah, sure. Let me start off with assets that are carried at fair value.
Yep.
So, for example, shares in a listed company. You value the shares in a listed company using the observable price at year end.
Yep.
So prices can change after year end, but you don't have to worry about those changes. Sometimes you're then carrying assets at fair value, but you're using like a valuation technique that might use discounted cash flows or something like that. When you're thinking about fair value of those sorts of assets, you need to make sure that you're including the market participant expectations around cash flows.
Yeah.
So you won't be making significant changes for what happens after year end, but you need to be making sure that you're thinking about, well, what would a market participant have done when they were coming up with their cash flow model? And then the last area are the sort of non-financial assets, the sorts of things that you're used to doing an impairment test, for a CGU or that sort of thing. And so in those scenarios, it's probably a lot like when we went through COVID, right? People are going to need to think about the impairment tests that they're doing. They might need to come up with some scenarios. What happens if tariffs are like this? What happens if tariffs are like this? And put some weighting to doing that sort of impairment test.
Yeah, that's really helpful. And then ASIC also releases a list of focus areas at year end, and they are looking at private and public companies in their part of their surveillance program. We know ASIC is focused on grandfathered entities. What can you tell us about ASIC's surveillance program?
You're right. ASIC looks at more than just public companies. They look at private companies as well. And what we've seen is because companies aren't grandfathered anymore and they have to prepare accounts, there's been a significant focus on those sorts of companies. They've been focusing to make sure that they're preparing their accounts and lodging them when they're due. The interesting thing was we're still seeing a lot of examples, not just for grandfathered companies, but also sort of the wider proprietary companies or subsidiaries of public companies, where ASIC is releasing a media release to say that they fined a company for not lodging their financial statements by their due date. But ASIC doesn't just make sure that companies lodge their financials. They also take an interest in the financial reporting, how those accounts are prepared under the surveillance program. So an interesting thing is ASIC will often issue a media release when they've sort of worked with a company and they've had them change something about their accounting. So some of the things we've seen over the last year are things like examples where a proprietary company hasn't actually been consolidating subsidiaries that it controls. We've seen examples where for impairment testing, so those non-financial assets, a company's had to book an additional impairment after having conversations with ASIC. And another area is around revenue recognition. So we've seen companies that were presenting revenue on a gross basis as a principal change to presenting their revenue on a net basis as an agent.
So if a company were to get a request from ASIC, what should they expect and what are some of the preparations they do to be effective and respond appropriately?
Yeah, so let me use impairment testing as an example. Right, so a regular letter that a company would get from ASIC is asking them about impairment testing. And what we see is they ask for a lot of information. They ask for the impairment calc, the sort of models that were built for impairment calculations. They ask for all of the information that supports the assumptions that go into those models. They ask for a reconciliation of the assets that appear on the balance sheet to the CGUs that have been tested. They reconcile the cash flows and the revenues and expenses to the impairment model to make sure that you're not leaving out significant expenses. And then we also see them ask for the information that you might get from third parties that helps sort of support or give you advice. So a really important thing for you to be aware of is, well, where are the areas of significant judgment when you're preparing your financial statements, right? What are the things that your auditor focuses on with you? What are the things that ASIC might take an interest in? And to make sure you've got really well documented the sort of thought process that you went through with your accounting.
Well, thank you, Paul. That was a really interesting discussion and one that I think we need to make sure the CFOs have the documentation to support their judgments at the time of doing the work so they can take the credit for the work they've done if they get asked. And it's clear there's a lot for you to consider. And if I was to summarise some of the takeaways from our discussion today, it's that you need to get ahead of the game. Think about, do you have any potential debt covenant breaches? And talk to your lenders early. Get clear on your reporting requirements for the companies in your group. Take into account grandfathered entities and supplier financing arrangements. And if there's additional disclosure, get onto it early. If you're impacted by tariffs, don't forget to think about the accounting implications as well as the commercial implications. Paul, thank you for your time today. It's been really valuable and insightful discussion and one I'm definitely taking back to my clients and teams.
Yeah, thanks for having me, Sarah.